Well, hello everybody. This is Ken Winans and Stephanie Larson from Winans Investments, and I know you're all eager for our what should we call it, our volatility video, so to speak. And let me go ahead and get started on this real quick. As you all know, the markets have been very volatile. There have been some very well-known company stocks that have vaulted up and then have blown up, and the volatility does increase as bear markets age, and this is something that I've experienced many times in my career. What I was going to tell you, that many of you have probably noticed that over the last week or so, we have been net raising cash in the accounts, and many of you have noticed that we've actually been sticking commodity ETFs in your portfolio. You've heard me talk about commodities quite a bit as an inflation type investment. So it's been a while since I've had these in a portfolio, but we are adjusting to the times, and we'll see what goes from there. A couple of comments. First off, it's still very early in the year. I do not think that the markets are going to go straight up. I don't think they're going to go straight down. But what the danger that you can do is overtrade the market and sell things at the wrong time at the wrong place, and or buy things at the wrong time in the wrong place. And a good case in point, there are probably some people who bought Tesla a week ago that are probably looking at themselves a little crazy right now. You have to be very careful in these markets. I do think that any perception of lagging in the performance, I would say that again, it's early in the year, and Stephanie's going to comment in a moment about the bond portfolios. But again, remember that we haven't gotten any dividend income, we haven't gotten any bond interest income. It's still very, very early in the year, so just kind of keep that in mind. Stephanie, what do you want to add?
Well, at least with the bond market, prices are starting to soften a little bit. This is a good thing. If a bond, if you look at their par value, what the normal value is 100. Anything over 100 is considered a premium. Anything under 100 is considered a discount. We, in general, try to buy bonds at discounts because, when the bond matures, you returned $100 per your bond. So we like that little kick at the end. What we've seen is that ever since the Fed has entered the market and, the yields have just, gone down a little. They're a little softer with the price going up, and most bond prices have been in the 110s, some 108s, 115s. We even had a bond that was in the 128s. I mean, that's insane for a bond. So the fact that they're softening is a good thing for us when we want to buy, And so what we're looking at is we actually cut a few of our bonds and took profits off the table by having them because the prices were just so astronomical. We're very comfortable with what's left in the portfolio. They're very strong. We actually don't have a single bond that we're concerned with at the moment. And it's getting a little bit easier to buy. I actually just bought a bond yesterday. It's tough because you want the prices to soften, but then you'll see your portfolio kind of soften a little with it. But they were these astronomical prices that just couldn't last forever. So we really wanted to see the spreads they were so tight. We wanted to see them widen out a little bit, make it a little easier for us to do our job and to purchase. So this is a good thing, actually. And we expect the trend to continue, actually, for a while.
I would also say this, and in lieu of what Stephanie just brought up, also it's the same with preferred stocks, which are, as you know, many of you in income portfolios, we do like these high dividend paying, particularly financial stocks, bank stocks. They're very nice, but again, they're also under pressure too. There's massive readjustments going on right now, and there are, at the Federal Reserve would call speculative excesses, which means there's a lot of people out there day trading some of these crazy stocks or commodities. I do want to bring up, and I think it's important not to look at any one quarter or any one year, but to look at things multi-years. I do. And 2019 was a fantastic year for us. 2020, although it was a roller coaster, turned out to be a very good year. Yeah. It is very hard for me to picture that we're going to have a third straight year in equities or bonds or in anything that is going to match those. I mean, it's a very long, low probability event to have 3 back-to-back years, and I'm including the 1990s. It did not even happen there. There was always a year that was very choppy, very miserable, and did test any strategy. I would say this, our tolerance for any stock, whether it is Apple or whether it is a very popular healthcare company, if they begin to break down, although I believe the companies are wonderful in the long term, but do not confuse the stock and the company. They are not one and the same. If you honestly think that Tesla is worth, after all that's changed in that company's future, 8 times more valuable in 6 months. That tells you the kind of crazy world we're in right now, folks. And you've got to be careful. There are times to take money off the table in any stock. I'm agnostic about the names. To me, although I might like their companies, I might use their products, I might admire their CEOs. That does not play a weight on me on playing a defensive nature within the portfolios unless a client has told us to hold it for their own reasons. So only other thing I would bring up, I'm keenly aware of taxes. We're aware that taxes might go up this year. When we decide to sell something, I'm aware that a lot of our clients have this in taxable accounts, and I have to put that into the thought as well. But if I have to choose between taking a hit in the portfolio and taxes that I can worry about, a year from now, I would much rather deal with the here and now and not let it get out of control, because again, that's just something that we can't do. Final point, hedges. We did use hedges last March, as many of you know. They are these ETFs that we do stick in every account, including IRAs. If the deterioration, I think that a 5 to 7% pullback from the high and the general indices is not out of the question. Anything more than that, you might actually see hedges put back in the portfolio as a precaution. So again, do not read into putting hedges in your portfolio as I think we're going to do a redo of March last year. I don't feel that, but it is our job to try to protect the portfolios and to try to keep things in line. So just kind of keep in mind, we're very busy here, we're very active, even in light of COVID. We are periodically getting tested for COVID to make sure we're all healthy. And just so you all know, we're trying to take this serious, but we have to still manage your portfolios. And Stephanie and I agreed a while ago, it's hard to do it remotely. We'd rather work together.
Yeah.
So, and by the way, this is the closest we are during the day. Outside
It
of
is.
that, we're 6 feet apart. So,
Yeah, I think it'd be also helpful for you guys to understand what we're looking at when we're looking at the stocks, because, we were on the phone literally yesterday in the morning, and we were looking at Apple. That's just a good example. And a pullback is one thing. We expect the volatility, we expect stocks to come down a little bit, but what we're looking at is an actual trend break. So I'm on the phone with Ken first thing in the morning going, is that breaking the trend line? I think it kind of is. And we'll look at it. We'll pop on our laptops and take a look at it. And we're concerned with that. It's not whether Apple's out of fashion or the fundamentals are breaking down, which they're not. People are taking profits off the table, and we expect this, to stop at some point. Apple is fundamentally strong. They have great cash flow. They're not going anywhere. So what's happening is sometimes nonsensical. Why would you sell Apple and buy Carnival? But that's what people are doing because they're making deep value plays. What we're concerned is not why someone's buying something or why someone's selling something. We actually don't care why they're doing it. We just need to know they're doing it, and we want to get ahead of it or join into it. So, for us, we're really looking at the technicals that are involved with the stocks, and that's dictating what we're selling. We're not raising cash and just selling everything in half. We're systematically dumping the names that are out of favor with us, that we no longer like, and that we feel have broken down in their shape and form and their technicals. And so those are what we're actually getting rid of.
absolutely. And then also just keep in mind that our job, we're not trying to use the age-old excuse of saying, well, it's a long-term investment. No, look, this is a long-running bull market. It's getting long in the tooth. I mentioned before, I feel that in some cases it is overbought. We do have to protect portfolios, and I have seen, for those of you who were with me in 2008, let's not forget, Apple and Amazon lost 60% of their value.
Yep.
So although they were fine and they grew, again, do not confuse stock with the company. Those are different animals entirely, and many things move a stock price that have nothing to do with the company. One other final point. I think it is safe to say that Stephanie brought up, deep value play. Do keep in mind that, many of these companies that have weathered the storm well, you can argue that they are now overpriced. These stocks are now trading in ranges that people could say they have taken it too far. So again, it's not uncommon to either have stocks go sideways for a long period of time or actually have a net very sharp pullback in price. So do keep that in mind, and that's something that we deal with, and that's what our research is designed to do. So anyway, this is a little long. We should stop here.
I'll make one last point. It's a long video, but I think this is helpful for clients because there's a lot of concern. We've started to feel the temperature rise with some of our clients, that they're getting a little nervous about what's going on. But I will say, though, that we also can strategically adjust the portfolios. If you're in a blended portfolio where you have fixed income exposure, you know, we might buy an extra bond or two for your portfolio just to beef it up, to have a little more safety, get a little more income. You know, income will you know, you get paid semi-annually, so that'll be nice when you get your income in. So that's something we can do just with our portfolios to make them a little bit safer. One thing to note though with the bond portfolio is that we have started to see calls again. You know, the companies are saying, I don't need to have that bond out there, I'm gonna call it back. We've seen at least a half a dozen, and some preferreds get called as well. So we have to be very active in the market, which is what we're doing. And it just takes, it's more art than anything else on the fixed income side than science, which is a little bit more on the equity side. But we are on top of everything, and we are very aware of what's going on in the market. We talk about it all day. We have investment committees, a couple a week actually, normally. And him and I just have an open communication all the time. So we are actively rotating, selling names we don't like, raising cash, and we might beef up a little on the fixed income side for everybody, just to make sure that they're
Absolutely.
good.
So hang in there, everybody. I know
Yeah.
that we're all tired of COVID, and I know we were hoping 2021 would be a little better. Let's hope it is later this year. But
Yes.
I more than anybody looks forward to get out and see you folks face to face. But we're a ways away from that happening, and you know, and hopefully see each other with our mask off, which is even farther down the road. So anyway, you all take care of yourself. Please feel free to call us if you need to make an appointment to talk in more detail about your specific portfolio. But anyway, we wish you well. Take care now.
Take care, guys.
Bye-bye.
Thank you.